Hey everyone, welcome. If you've spent any time behind the wheel this year, whether you're driving for Uber, Lyft, or dropping off DoorDash orders, this session is for you. We're diving into the 2026 Canadian Tax Guide for gig drivers. My goal today isn't just to help you file a return, it's to make sure you're protecting your Canadian dream by keeping more of your hard-earned money and staying on the CRA's good side. The tax world for gig workers has changed massively in the last 24 months. We're not in the wild west of the gig economy anymore. The CRA has leveled up their tech, and today we're going to talk about what that means for your pocketbook and your peace of mind. Let's be real for a second. You know how the apps track your every turn? Well, now the CRA has a similar view. Under the new federal legislation rules, platforms like Uber and Skip now send your earnings directly to the taxman. If what you report doesn't match what they see on their screen, it triggers an instant red flag. We're going to make sure your numbers are bulletproof. Here is our roadmap for today. We'll start with the basics of being a business owner. Yes, you are a business owner. Then we'll tackle the GST, HST headache, walk through how to maximize your vehicle expenses, and finish with a strategy to make you audit-proof for the 2026 season. Take a look at this. Many drivers think they are just contractors. In the eyes of the CRA, you are a sole proprietor. You are an entrepreneur. That means you don't get a T4. You file a T2125. It also means you're responsible for your own CPP contributions. It sounds heavy, but it actually gives you the power to deduct expenses that a regular employee can't. Write these dates down. Everyone talks about June 15th for self-employed people, and yes, that is your filing deadline. But here's the trap. April 30th is when your payment is due. If you owe money and wait until June to pay it, the CRA will charge you interest starting May 1st. And trust me, with the 2026 interest rates sitting around 9.5%, that's a bill you don't want. Now, let's talk about the T2125. This is the Statement of Business Activities. Think of this as the story of your year in numbers. It's where we tell the CRA how much you made and, more importantly, how much it cost you to make it. Details matter. If you're driving passengers, use code 485310. If you're delivering food, it's 492110. Why does this matter? Because the CRA compares your expenses to the average for your industry. If you use the wrong code, your expenses might look unusual to their computer, which is an invitation for an audit you don't want. This is the number one mistake I see. For delivery-only drivers, you don't have to register until you hit $30,000 in revenue. But for rideshare, you have to register from $1. If you've been driving passengers without a GST number, we need to fix that immediately to avoid massive backdated penalties. GST isn't all bad news, though. When you register, you get to claim ITCs. That means the GST you paid on your gas, your new tires, or your phone bill, you get that money back. It's essentially a 5 to 13% discount on your business operating costs. But remember, a credit card statement isn't a receipt. Keep those paper or digital tax invoices. Now for the big one. Your car is your biggest expense and your biggest tax break. Let's look at how to do this the right way so you don't leave thousands of dollars on the table. Look at the gap in this chart. If you only use the active kilometers shown on your Uber or Lyft app, you are losing money. The app doesn't track your deadhead kilometers. That's the driving you do between trips or on your way to a busy area. Tracking every business kilometer is the difference between a small refund and a massive one. The 2026 rates are finally reflecting the reality of inflation. We're looking at around 73 cents per kilometer for your first 5,000 kilometers. This is meant to cover gas, wear and tear, and insurance. If you aren't tracking your mileage properly, you're essentially handing this money back to the government. It's not just about the car. Your smartphone is your office. Deduct a portion of that data plan. Those insulated bags you bought for DoorDash, deduct them. Even the water bottles or mints you keep in the bag for 5-star ratings are legitimate business tools. If it helps you earn, it's likely a deduction. I cannot stress this enough. No logbook, no deduction. If the CRA calls you for a desk audit, the first thing they will ask for is your mileage log. In 2026, a handwritten notebook is okay, but a digital app that tracks your GPS start and endpoints is the gold standard that the CRA rarely disputes. Let's talk about how to stay audit-proof.
An audit isn't a sign you did something wrong, it's often just a random check. But if you're prepared, an audit is just a 15-minute phone call instead of a 3-month nightmare. Why does the CRA pick one person over another? 40% of the time, it's just logbook gaps. Their system sees high vehicle expenses but no supporting data. Another 20% is an income mismatch where the driver forgets to report one of the platforms they worked for. We're going to make sure your map looks different. Don't wait until April to find your receipts. Make it a monthly habit. Every 30 days, digitize your receipts and check your mileage app. By the time February rolls around, you won't be stressed. You'll be ready to file while everyone else is scrambling. At the end of the day, why are we doing all this paperwork? It's because you have goals. Whether it's buying your first home in Canada, getting a business loan, or securing your PR, the bank and the government want to see clean, honest tax returns. Compliance isn't just a chore, it's your ticket to financial growth. Thank you for your time today. Taxes for gig work can be confusing, but you don't have to do it alone. Start by downloading a tracking app tonight and let's get those questions answered. What's on your mind?